Start Small. Grow Wealth from Nothing. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. Imagine standing in line at a coffee shop, clutching a few dollars in change, wondering if these small amounts could ever amount to anything more. Now, what if I told you that those very coins, often left to gather dust, hold the potential to grow into the wealth you've always dreamed of? In Start Small. Grow Wealth from Nothing will unlock a truth that could change everything you believe about building wealth. Here's the secret. You don't need a trust fund, a six-figure salary, or a winning lottery ticket to secure your financial future. Wealth isn't a privilege reserved for the already rich, it's the reward of small, consistent actions taken over time. This book reveals how tiny investments, like those forgotten coins in your pocket, can lead you on a path toward financial freedom. This isn't just about money. It's about freedom, security, and the power to take charge of your life. You're probably listening right now because you want to break free from the cycle of paycheck to paycheck living. Or maybe you're searching for a path that feels realistic and achievable. If you've ever felt that true wealth was out of reach, this book is here to show you otherwise. You have the power to create real change, to start small, and grow beyond limits. Together we'll explore practical steps that make wealth building accessible, no matter where you're starting from. This journey will guide you to transform spare change into meaningful financial growth, empowering you to make smart, lasting decisions that bring you closer to the life you desire. As we begin, consider these words from the American poet Robert Frost. The best way out is always through. Today you're choosing to move through the barriers of financial limitation, toward a future built on steady, intentional growth. Let's start small. Chapter 1. The Power of Starting Small. Imagine this: a single dollar you put aside today has the power to grow into something far more significant tomorrow. Most people think they need thousands of dollars to start investing, but in reality, it's the consistent, small contributions that often make the biggest difference over time. This chapter is about redefining what it means to start small and how that mindset can be the foundation of achieving your financial dreams. One of the most common misconceptions about investing is that it's only for people who already have a lot of money. We're often surrounded by success stories that showcase individuals making big moves with big amounts, but rarely do we hear about the ones who started with next to nothing and grew their wealth over time. The truth is, investing small amounts consistently can yield impressive results, and it's entirely possible to build wealth, even if you're starting with modest means. Think about it this way: if you have $10, $20, or even just spare change left at the end of the day, you have a foundation to start investing. It's not about the amount you start with, it's about the habits you form. The critical factor is creating a sustainable approach that you can stick with for years, allowing your investments to grow and compound. If you're like most people, big financial goals can seem intimidating. How do you go from where you are today to financial security? The answer is to start by setting small, achievable goals. For instance, decide to set aside $5 a week or $20 a month. When you set smaller, more attainable goals, you're much more likely to succeed and stay motivated. It's these small wins that build momentum and give you the confidence to continue. Let's break this down. Imagine you start by investing $50 a month. That's only $600 a year. Now, with the right strategy and patience, that $600 can grow significantly over time. It's not about hitting it big all at once, it's about building wealth incrementally, understanding that each step forward brings you closer to your ultimate financial goals. One of the most powerful benefits of starting small is the confidence it builds over time. When you see your investments, even small ones, growing, it reinforces your belief in the process. Every small deposit you make becomes a proof point, showing you that you're on the right path. Watching your investment grow, no matter how gradually, becomes a source of encouragement. Confidence comes from taking action, even if those actions are small. By starting now with whatever you have, you're setting the stage for long-term success. Each time you invest, you're proving to yourself that you can take control of your finances, that you're capable of building a secure future. This confidence will be critical in helping you stay the course when challenges arise. To bring this concept to life, consider the story of Sarah, a young professional who had very little disposable income, but was determined to start investing. She began with just $25 a month, choosing to invest in a diversified portfolio of index funds. Over 5 years, she increased her contributions gradually, whenever her financial situation allowed. Today, her portfolio has grown, and her confidence along with it. Sarah didn't become wealthy overnight, but she's well on her way, and she credits her success to starting small. Then there's Michael, who was living paycheck to paycheck but wanted to change his financial future. He started by saving the change from every purchase he made, rounding up each transaction and investing the difference. This small but consistent action helped him accumulate hundreds of dollars over a year, which he then invested in stocks and bonds. Michael's story is a testament to the power of micro-investing, a strategy that works precisely because it doesn't require large sums to begin. Now, let's talk about why consistency is so important. Consistent investing leverages the power of compound interest. With compound interest, your money grows exponentially, as you earn interest on both your initial investment and the interest it accumulates. Even modest amounts, invested consistently over time, can grow into substantial sums. Take a simple example: if you invest $100 every month at a 7% annual return, you would have approximately $12,000 after 10 years. That's not just $12,000 from your own contributions, but also from the compound interest that's been working in your favor. And what did it require? Just $100 a month. This is why starting small is so powerful. When combined with time, small investments can lead to major growth. There's never a perfect time to begin, but the best time to start investing is now. Every day you wait is a missed opportunity for your money to grow. The earlier you start, the longer you give your investments to compound. Even if you feel like your initial contributions are insignificant, remember, every dollar counts. The sooner you begin, the sooner you'll start seeing the benefits of your investments. Small investments may feel like drops in a bucket, but each drop adds up. Your financial dreams are within reach. You just have to start, no matter how small that start may seem. Chapter 2. Shifting your mindset. From scarcity to abundance. Have you ever caught yourself thinking, "I don't have enough money to save or invest"? This is a common belief that stems from a scarcity mindset, a perspective that focuses on limitations rather than possibilities. Shifting from a scarcity mindset to an abundance mindset is a crucial step in unlocking your financial potential, no matter how small your starting point. The scarcity mindset convinces us that resources are finite, and that there's never enough to go around. It breeds fear and hesitation, making us believe that taking risks or investing isn't for people like us. This mindset can be paralyzing, causing us to miss out on opportunities because we're too focused on what we lack. For example, you might think that investing is only for the wealthy, or that saving a few dollars won't make a difference. These thoughts create a self-fulfilling prophecy, where inaction leads to stagnation. The more we believe we can't, the less we try, and the cycle continues. An abundance mindset flips the script. Instead of fixating on limitations, it encourages us to see the wealth of opportunities available. It's about recognizing that even small resources can grow when managed wisely. This mindset doesn't ignore challenges but approaches them with optimism and creativity. Imagine viewing every dollar as a seed with the potential to grow into something greater. With an abundance mindset, you start to see possibilities where you once saw barriers. This shift opens doors to new strategies and approaches that can significantly impact your financial journey. Fear is a natural response when stepping into unfamiliar territory. However, allowing fear to dictate your financial decisions can hold you back. Reframing your fears involves acknowledging them but choosing to act despite them. Consider asking yourself, what is the worst that could happen if I start investing small amounts? Often, the risks are minimal compared to the potential benefits. By addressing your fears directly, you diminish their power over you. When you adopt an abundance mindset, obstacles transform into opportunities for growth. Tight budget? It's a chance to hone your budgeting skills. Limited knowledge? It's an opportunity to learn and expand your understanding. For instance, numerous apps and platforms today allow you to start investing with just a few dollars. These tools are designed to make investing accessible, turning what might seem like a financial obstacle into a stepping stone towards your goals. Steps to shift your mindset. 1. Practice gratitude daily. Start or end each day by listing things you're grateful for. This habit shifts focus from what you lack to what you have. 2. Set realistic goals. Break down your financial objectives into small, achievable steps. Celebrate each milestone, no matter how minor it seems. 3. Surround yourself with positivity. Engage with content and people who encourage growth and positivity. This environment fosters an abundance mindset. 4. Invest in self-education. Knowledge empowers. Read books, listen to podcasts, or take courses on personal finance to build confidence. 5. Visualize success. Spend time imagining your financial goals realized. Visualization reinforces belief in your ability to achieve them. Incorporate positive affirmations into your daily routine to reinforce an abundance mindset. Phrases like "I am capable of growing my wealth" or "every small step counts toward my financial success" can rewire your thinking patterns over time. Consider Mia, who always believed that investing was beyond her reach due to her modest income. After shifting her mindset, she started investing just $10 a week. Over time, not only did her financial situation improve, but her confidence grew, leading her to seek better job opportunities and further increase her investments. Then there's Alex, who reframed his fear of losing money into a motivation to learn. By educating himself on low-risk investment options, he began with small amounts and gradually built a diversified portfolio. His story illustrates how a mindset shift can lead to tangible financial growth. Remember that every large fortune started somewhere. Consistency with small amounts can lead to significant growth due to compound interest. Fear of market volatility. While markets fluctuate, history shows a general upward trend over the long term. Starting small allows you to weather short-term ups and downs. Thinking it's too late to start, it's never too late. The best time to start was yesterday. The next best time is now. Your environment greatly influences your mindset. Create a space, both physical and mental, that supports your financial goals. This could mean organizing your workspace, decluttering your finances, or engaging with communities that share your aspirations. Shifting to an abundance mindset doesn't just impact your finances, it enhances your overall quality of life. You'll find increased motivation, better relationships, and a more optimistic outlook. This positivity can inspire those around you, creating a supportive network that benefits everyone involved. Embracing an abundance mindset is an ongoing process. Be patient with yourself as you make this shift. Celebrate progress, learn from setbacks, and keep your vision focused on the possibilities ahead. Remember, changing your mindset is the first small investment you make, one that can lead to profound growth in all areas of your life. Chapter 3. Understanding financial tools and platforms for small investments. Now that you've embraced the idea of starting small and adopted an abundance mindset, let's talk about the tools and platforms that make investing accessible, even with limited resources. Knowing where to start can feel overwhelming, but with the right guidance, you'll find that investing has never been more approachable. Micro-investing apps like Acorns, Stash, and Robinhood have revolutionized the way people with modest means can participate in the financial market. These platforms allow you to invest with as little as $1, making it possible to start building wealth, even if you're working with a small budget. Many of these apps also offer educational resources and make the experience of investing feel more like a game, which can be motivating and fun. With apps like Acorns, for example, you can round up your everyday purchases to the nearest dollar, investing the spare change. Imagine buying a coffee for $2.75, and Acorns automatically rounds it up to $3, putting that 25 cents into an investment account. Over time, these small amounts add up and start working for you through the power of compound growth. High-yield savings accounts offer higher interest rates than traditional savings accounts, making them a smart choice for people who want a safe place to grow their money. These accounts are particularly helpful for beginners who may be hesitant to invest directly in the stock market. With interest rates that are typically 10 to 20 times higher than standard savings accounts, HISAs allow your money to grow steadily, even if you're starting with a small amount. These accounts can be found at online banks or credit unions, and usually have low or no minimum balance requirements. They're a great way to start building an emergency fund, or saving for a specific goal, without the risk associated with stocks or other investments. Robo-advisors like Betterment and Wealthfront have gained popularity for providing low-cost, automated investment services. For a minimal fee, these platforms use algorithms to manage your investments based on your goals, risk tolerance, and time horizon. This option is ideal for people who want to start investing without needing to actively manage their portfolios. One of the key benefits of robo-advisors is their accessibility. You can start with small amounts, and they often provide a well-diversified portfolio balancing stocks, bonds, and other assets to minimize risk. If you're new to investing and don't want to spend time researching individual stocks, robo-advisors offer a hands-off approach to building wealth. Exchange-traded funds ETFs are another great option for beginners. ETFs pool money from many investors to buy a diverse range of assets, such as stocks or bonds. Because you're buying a share of the entire fund, rather than individual stocks, ETFs offer built-in diversification, which can reduce risk. ETFs are particularly attractive to small investors because they have low fees and can be bought in small amounts. Platforms like Robinhood and Fidelity allow you to purchase fractional shares of ETFs, meaning you can invest as little as a few dollars to start. This is a powerful way to gain exposure to a wide variety of companies and industries without needing a large amount of capital. Peer-to-peer P2P lending platforms like LendingClub or Prosper offer an alternative way to grow your money. With P2P lending, you invest in loans for individuals or small businesses, earning interest as they repay. Although these platforms involve a bit more risk compared to traditional savings or stock investments, they also offer higher potential returns. Starting small in P2P lending is possible, with many platforms allowing investments as low as $25 per loan. This lets you diversify your lending portfolio, reducing the risk associated with any single borrower defaulting. P2P lending is ideal for people who are comfortable with moderate risk and interested in an alternative investment route. No matter the size of your investments, fees can significantly impact your returns over time. Look for platforms that offer low or no fees on trades and transactions, especially if you're investing small amounts. Apps like Robinhood and Fidelity, for example, allow commission-free trading on stocks and ETFs, which is particularly valuable for small investors who want to make frequent trades without losing a large percentage to fees. It's also wise to look into the expense ratios of any ETFs or mutual funds you're considering. These fees, while often less visible, can accumulate over time and eat into your returns. The good news is that many low-cost ETFs have expense ratios under 0.1%, making them affordable and accessible options for long-term growth. One of the best strategies for small investors is to automate their contributions. Setting up automatic transfers to your investment accounts ensures that you're consistently putting money toward your financial goals, even if it's only a few dollars at a time. Many micro-investing apps and robo-advisors offer this feature, allowing you to set it and forget it. Automating your investments helps to build a habit without requiring ongoing effort. Plus, it takes advantage of dollar-cost averaging, a strategy where you invest regularly regardless of market fluctuations. This can lower the average cost per share over time, smoothing out the highs and lows of the market. Before diving into any investment, it's essential to understand your risk tolerance. Some tools, like high-yield savings accounts, carry virtually no risk, while others, like P2P lending or individual stocks, involve higher risk. Knowing what level of risk you're comfortable with will help you choose the right mix of tools and platforms. To determine your risk tolerance, consider your time horizon, how long you plan to invest before needing the money, and your personal comfort with market ups and downs. The goal is to find a balance that allows you to grow your wealth without losing sleep over your investments. The beauty of starting small is that you have the flexibility to explore different platforms and find what works best for you. For short-term goals, high-yield savings accounts might be the best fit. For long-term growth, ETFs and robo-advisors offer excellent low-cost options. If you're willing to experiment with alternative investments, P2P lending could provide higher returns with moderate risk. As you begin your investing journey, remember that these tools are not one-size-fits-all. Take the time to explore your options, learn about each platform, and decide which aligns best with your unique financial goals. Chapter 4. The Magic of Compound Interest. Time is your friend. What if I told you that time could be one of your greatest assets in building wealth? This chapter is all about harnessing the power of compound interest, a concept that transforms small, consistent investments into significant financial growth over time. Understanding compound interest is essential to see the true potential of starting small and staying committed. Compound interest is often described as interest on interest. Unlike simple interest, which only earns on the original principal, compound interest allows your investment to grow not only on the initial amount but also on the accumulated interest. Over time, this creates a snowball effect, where your money grows faster and faster, without you needing to add substantial new contributions. Imagine this: if you invest $100 with a 5% annual interest rate, you'll have $105 after the first year. But in the second year, you'll earn 5%, not just on the initial $100 but on the full $105, and so on. With each passing year, the growth rate accelerates. This compounding effect is why starting small and starting early is so powerful. Starting early is one of the most effective ways to take full advantage of compound interest. The earlier you begin, the more time your money has to grow exponentially. Even a few years can make a dramatic difference. Let's look at a simple example. Suppose two people, Jane and Mark, both invest $100 per month at a 7% annual return. Jane starts at age 25, and Mark starts at 35. By the time they both reach age 65, Jane will have contributed $48,000 and have around $240,000 in her account, thanks to compound interest. Mark, despite contributing the same monthly amount, will end up with significantly less because he started 10 years later. This example illustrates that time, even more than the amount invested, plays a crucial role in wealth building. One of the most exciting aspects of compound interest is that it doesn't require large sums to get started. Even small amounts invested consistently can accumulate significantly over time. This is why starting small isn't just practical, it's powerful. With the compounding effect, each dollar invested today is worth more than a dollar invested tomorrow. For instance, let's say you invest $50 every month at a 6% annual return. After 10 years, you would have invested a total of $6,000, but your account would be worth over $8,000. The difference of $2,000 might seem modest, but it was generated entirely through interest, not additional contributions. This is the magic of compounding at work, illustrating how small, regular investments grow with time. The flip side of compound interest is that waiting too long to start investing can significantly reduce your potential growth. Every year you delay, you miss out on the exponential growth that compounding provides. Waiting to invest is like leaving money on the table. Time can be an invaluable asset in your financial toolkit. Consider the same scenario above, but imagine starting just 5 years later. Instead of reaching $8,000, you might only have around $6,500, simply because of those missing years. This difference underscores the importance of starting as soon as possible, even with a modest amount. Examples of compound interest are everywhere, from retirement accounts to savings accounts to investment portfolios. Think of individuals who started saving early in their careers and continued small, regular contributions for decades. Many retirees have amassed impressive savings solely due to the power of compounding. Take John, for instance, who started saving just $25 a week at age 30. By the time he reached 60, his savings had grown substantially, even though his weekly contributions were relatively small. When asked how he managed to build such wealth, he credits starting early and sticking to his plan. Then there's Emma, who began saving small amounts in her teens by investing her allowance and part-time job earnings in a diversified fund. By the time she graduated from college, Emma had a solid financial foundation. Her experience exemplifies how the combination of time and compound interest can work wonders, even with modest beginnings. To benefit fully from compound interest, consistency is crucial. Making regular, scheduled contributions, no matter how small, keeps the compounding effect in motion. While it may be tempting to skip a contribution here or there, every missed opportunity slows down the growth potential. This is why automating your contributions can be incredibly helpful. It removes the temptation to delay or skip, ensuring that you're always moving forward. Consistency also prevents investment fatigue, a common experience where people feel discouraged by the slow early growth of their investments. By focusing on the process rather than immediate results, you're more likely to stay motivated and stick to your plan, allowing compound interest to work in your favor. Compound interest rewards patience. The longer you leave your money invested, the greater the compounding effect. This is why it's often said that time in the market beats timing the market. Trying to make short-term gains by predicting market movements is much riskier than simply staying invested over time and allowing compounding to do its job. Over decades, compounding creates a hockey stick effect where growth starts slowly and then accelerates dramatically. Those who stay invested for the long term can potentially see their wealth multiply, making compounding one of the most powerful forces in personal finance. Think about your future self, the person who will benefit from the small investments you're making today. Every dollar you invest now is a gift to your future self, a financial buffer that will give you options, security, and freedom. Visualizing the long-term benefits of compound interest can make it easier to stay motivated, even when the results don't appear immediate. Instead of seeing it as just money growing, consider it as your future life being enriched. Compound interest means that every small investment now could translate into a better quality of life later, more freedom to pursue passions, support family, travel, or retire comfortably. If you're ready to harness the power of compound interest, here's a quick recap to get started. 1. Start now. Don't wait for the perfect amount, start with whatever you can afford. 2. Be consistent. Set up regular contributions, even if they're small. Automation is your friend here. 3. Focus on the long term. Resist the temptation to withdraw early. The longer you stay invested, the more powerful the compounding effect. 4. Reinvest earnings. If your investments generate dividends or interest, reinvest them to maximize compounding. By following these steps, you can leverage compound interest to turn small beginnings into a secure financial future. Chapter 5. Small steps to consistent growth. Creating an investment habit. Now that you understand the potential of compound interest, it's time to put that knowledge into action by developing an investment habit. This chapter focuses on the power of consistency, showing how small, regular contributions can set you on the path to financial growth. Just like any new habit, investing becomes easier with practice, and with each step you build a stronger foundation for your future. Consistency is the backbone of successful investing. Small, regular contributions are more effective than occasional, larger deposits because they create a disciplined approach that builds over time. This consistency is what allows compound interest to work in your favor. Think of it like a fitness routine. A few minutes of exercise daily is more effective in the long run than sporadic intense workouts. When you commit to regular investments, even if they're modest, you're cultivating a habit that reinforces financial stability and growth. Over time, this habit turns into an automated process, requiring less conscious effort but delivering significant benefits. One of the biggest barriers to creating an investment habit is setting goals that feel out of reach. Rather than aiming for a large amount, start with something manageable. For instance, commit to setting aside $10 or $20 a week. While this amount may seem small, it's enough to get you into the habit and start seeing progress. Let's break this down. If you save $20 a week, that's over $1,000 a year, even before accounting for any potential investment growth. The key here is that small, achievable goals build confidence and momentum, encouraging you to keep going and even increase your contributions over time. One of the most effective ways to ensure consistency is by automating your contributions. Nearly every bank, investment app, and brokerage offers options for automatic transfers. This feature allows you to set a schedule that suits your budget, ensuring that you're consistently investing without needing to think about it. Automating your investments removes the decision-making process and makes investing as natural as paying a bill. You'll be less tempted to skip a contribution because the process is already in motion. Automation is especially helpful when starting small, as it takes away the burden of manually making each investment, helping you stay on track effortlessly. Creating any habit comes with obstacles, and investing is no different. It's normal to face periods where unexpected expenses, doubts, or other life events make it difficult to stay consistent. The key is not to let these moments derail you. Instead, think of setbacks as temporary pauses rather than failures. If you miss a contribution, simply resume the next month rather than trying to catch up. Trying to compensate for missed contributions can lead to stress and discouragement. Remember, the most important aspect of an investment habit is long-term consistency, not perfection. Before focusing solely on investments, it's wise to have a basic emergency fund in place. Financial setbacks like car repairs, medical bills, or other unexpected expenses are inevitable. An emergency fund, typically covering 3 to 6 months of expenses, helps protect your investments from being tapped into during tough times. Starting with an emergency fund also reinforces the habit of saving regularly. Once this fund is in place, you can gradually shift your focus toward investing, knowing you have a financial cushion. This approach makes your investment habit more sustainable, reducing the likelihood of needing to interrupt your investments. As you develop your investment habit, it's natural to make small adjustments as your financial situation changes. Perhaps you receive a raise or finish paying off a loan, freeing up extra money to invest. Incremental increases in your contributions can accelerate your growth without feeling overwhelming. Think of it as climbing a staircase. Each step builds on the last, and by gradually increasing your investments over time, you're maximizing growth without straining your budget. Even adding an extra $10 a month can have a meaningful impact over the long term, especially when combined with compound interest. Financial habits are like any other habit, they require reinforcement. Celebrating milestones, no matter how small, helps reinforce your commitment to the process. When you reach your first $500 or $1,000 in investments, take a moment to appreciate the progress. This sense of accomplishment fuels your motivation and strengthens the habit. For example, if your goal is to invest $5,000 over the next few years, break it down into smaller targets, like reaching the first $500 or $1,000. Recognizing each of these milestones not only keeps you motivated but also makes the journey feel rewarding. One of the advantages of consistent investing is that it allows you to use dollar cost averaging. This strategy involves investing a fixed amount regularly, regardless of market conditions. Over time, this approach lowers the average cost per share, as you'll buy more shares when prices are low and fewer when prices are high. Dollar cost averaging protects you from the emotional swings of the market. You're less likely to make impulsive decisions based on market highs or lows because your investment schedule remains the same. By staying consistent, you smooth out fluctuations and reduce the risk associated with market timing. A helpful way to stay committed to your investment habit is by visualizing your progress. Many investment apps and online platforms provide graphs and reports that show how your investments are growing over time. Watching your portfolio increase, even if it's slowly, reinforces the value of your habit and keeps you motivated. Some people also find it useful to create a vision board or a goal tracking system. Having a tangible representation of your progress can make your financial journey feel more real and achievable, helping you stay on track. Imagine how your small, consistent efforts could grow over the years. Not only are you building wealth for yourself, but you're also creating a foundation that could benefit future generations. By establishing this habit, you're setting an example of financial responsibility that can inspire others around you, family members, friends, or even a broader community. Think of your investment habit as a legacy you're creating, not just for your own future but as a model for others. By starting small and staying consistent, you're building something meaningful that goes beyond immediate financial gains. Chapter 6: The Importance of Patience and Resilience. Investing is a journey that rewards those who stay the course, especially when the going gets tough. In this chapter, we'll explore why patience and resilience are essential traits for successful investors. Markets have their ups and downs, but those who remain patient and resilient often find that these qualities help them achieve their long-term financial goals. When you start investing, it's natural to want immediate results. However, true growth doesn't happen overnight, it requires time. The principle of compound interest thrives on patience, turning small, consistent investments into substantial growth over years and decades. The challenge, though, is learning to be patient even when progress seems slow or market conditions are uncertain. Consider how seeds grow into trees. If you dig up the seed every day to see if it's growing, you'll never allow it to take root and flourish. Investing works similarly. By giving your investments time, you allow them to grow undisturbed, taking advantage of compounding and market growth. Markets move in cycles, they go up, they go down, and sometimes they remain stagnant. These cycles are normal and are influenced by various factors: economic trends, political events, and global incidents. When markets take a downturn, it's easy to panic, but understanding that these cycles are a natural part of investing can help you maintain perspective. For example, in recent history, the 2008 financial crisis caused markets to plummet, but those who remained invested saw a strong recovery in the following years. The key to resilience is recognizing that downturns are temporary, and the market's long-term trend has historically been upward. By staying invested, you avoid the risk of missing out on future gains that often follow these downturns. Emotional investing is one of the most common pitfalls for beginners. When markets are high, people tend to buy impulsively, fearing they'll miss out on gains. Conversely, when markets are down, they might sell in a panic, fearing further losses. Both reactions are understandable, but they can lead to significant financial losses over time. One of the best ways to counter emotional investing is to stick to a long-term strategy and remind yourself of your goals. Having a plan in place can help you stay grounded and avoid making impulsive decisions that could hurt your portfolio. If you find yourself feeling anxious about market movements, revisit your initial reasons for investing and the long-term benefits of staying the course. Resilience is about adapting to challenges and staying focused on your goals, even when faced with setbacks. Investing is a long-term journey, and just like any worthwhile pursuit, it requires a degree of mental toughness. Developing resilience means accepting that there will be times of uncertainty, but trusting in the process. One way to build resilience is by educating yourself on market history. When you understand that downturns are a normal part of investing, you're more likely to ride them out. Staying informed helps you view market drops as opportunities rather than threats, allowing you to stay confident and committed. In previous chapters, we discussed the concept of dollar-cost averaging, investing a fixed amount at regular intervals. This strategy is especially effective during market downturns. When prices are low, your fixed investment buys more shares, which can lead to greater growth when the market recovers. Dollar-cost averaging also helps you avoid the stress of trying to time the market, which is incredibly challenging, even for seasoned investors. By sticking to a consistent investment schedule, you're taking advantage of market fluctuations rather than letting them dictate your actions. This approach strengthens your resilience, as it keeps you invested during both good and challenging times. Patience and resilience are rooted in setting realistic expectations. It's easy to be drawn into success stories of people who made fortunes overnight, but the truth is that those stories are rare exceptions. Most wealth is built gradually, through small, steady steps over time. By understanding that investing is a marathon, not a sprint, you set yourself up for success. Remind yourself that slow and steady progress is still progress. By expecting a gradual climb rather than quick results, you're less likely to feel discouraged by temporary setbacks or slower than expected growth. Embracing this mindset makes the journey feel less daunting and more rewarding. The uncertainty of the market can be intimidating, but learning to accept it as part of the process is a key component of resilience. When you acknowledge that some things are out of your control, you free yourself from the pressure to predict or react to every fluctuation. Instead, you can focus on what you can control: your investment strategy, your spending habits, and your goals. To build this mindset, try focusing on the long-term benefits of investing rather than the short-term fluctuations. Visualize the financial freedom you're working toward, and use that vision as motivation to stay the course. The more comfortable you become with uncertainty, the stronger your resolve will be to stick with your plan. Every setback is a chance to learn and grow. Instead of viewing downturns or mistakes as failures, try to see them as opportunities for growth. For example, if you experience a market downturn, analyze how it affected you emotionally and financially. Reflecting on these experiences can help you better prepare for future challenges. Consider keeping an investing journal where you note down market events, your reactions, and lessons learned. This habit helps you track your progress, recognize patterns in your behavior, and develop a more resilient mindset over time. By turning setbacks into learning experiences, you empower yourself to become a stronger investor. Patience and resilience don't have to be practiced alone. Surrounding yourself with like-minded individuals can make a huge difference. Joining investing groups, forums, or even following financial content creators who promote patience and long-term thinking can provide support and encouragement. Having a community can remind you that you're not alone in your journey and that many others are facing similar challenges. This sense of camaraderie can make it easier to stay the course, even when times are tough. Additionally, learning from others' experiences can deepen your understanding and give you strategies to apply in your own investment journey. Patience and resilience aren't just tools for surviving market downturns, they're essential ingredients for achieving long-term financial success. By staying the course, you're positioning yourself to reap the rewards that come with time. Remember, investing is about the cumulative effect of small, consistent actions over years and decades. Imagine the peace of mind that comes with knowing your investments are working for you, even when the market is unpredictable. With each year that passes, your patience and resilience compound along with your financial gains, bringing you closer to your goals. Chapter 7. Making adjustments and scaling up gradually. You've built a solid foundation by starting small, staying consistent, and developing patience. Now let's talk about the next step: scaling up your investments as your financial situation improves. Gradually increasing your contributions not only accelerates your progress but also maximizes the potential of compound interest. This chapter explores how to scale up responsibly, manage risk, and adjust your strategy over time. Think of your financial journey as climbing a mountain. You start at the base, taking small, steady steps upward. As you gain confidence and resources, you're able to take bigger steps without overexerting yourself. Similarly, in investing, it's wise to start small, build habits, and gradually increase your investments over time. Gradual growth allows you to scale up without the pressure of making drastic changes. Instead of jumping from $50 a month to $500, you might start by increasing to $75 or $100. These incremental increases make scaling feel manageable and sustainable. By growing in this way, you're better prepared to handle larger investments while minimizing stress. Before scaling up, take a moment to revisit your financial goals. Are you saving for a specific purpose, like a home, education, or retirement? As you gain financial stability, your goals may evolve. Clarifying these goals helps you set a realistic target for scaling up your investments. Let's say you initially started investing to build an emergency fund. Now that you've reached that goal, you may want to direct your contributions toward retirement or a down payment for a home. Defining your goals allows you to allocate your resources more effectively and makes scaling up a strategic part of your financial journey. When you're ready to increase your contributions, it's important to budget for these changes. Start by assessing your current income, expenses, and financial obligations. Look for areas where you might have excess funds, perhaps from a raise, a paid-off loan, or lifestyle changes, that you could redirect into your investments. One strategy is the 10% rule. Each time your income increases, allocate 10% of that increase toward your investments. For instance, if you receive a $200 raise per month, commit an additional $20 to your investment account. This approach allows you to scale up your contributions without feeling a significant impact on your day-to-day finances. As you begin to invest larger amounts, it's crucial to assess your risk tolerance. While small investments might have felt low risk, larger contributions may make market fluctuations more noticeable. To balance this, consider diversifying your portfolio. Diversification spreads your investments across different asset types, stocks, bonds, and ETFs, which can reduce your overall risk. If you're new to diversification, start by researching different asset classes and consulting a financial advisor if needed. The goal is to build a portfolio that aligns with both your financial goals and your risk tolerance, allowing you to scale up with confidence. As your investments grow, rebalancing your portfolio becomes an important practice. Rebalancing involves adjusting the proportions of different assets in your portfolio to maintain your desired risk level. For instance, if stocks have performed well and now make up a larger portion of your portfolio than intended, you might sell some of them and reinvest in bonds to restore your balance. Consider rebalancing at least once a year, or whenever there's a significant market change. This practice helps you stay aligned with your goals and keeps your portfolio from becoming too heavily weighted in one area. Once you've established a stable portfolio, you may want to consider allocating a small portion of your investments to higher growth opportunities. This might include individual stocks, small cap funds, or emerging market ETFs. While these investments carry higher risk, they also offer the potential for higher returns, which can help accelerate your growth. A general guideline is to keep high-growth assets to around 10 to 20% of your portfolio, depending on your risk tolerance. This approach allows you to take advantage of growth opportunities without overexposing your portfolio to volatility. Remember, these investments should complement, not replace, the core of your stable, diversified portfolio. If you're using automated contributions, scaling up becomes even easier. Many platforms allow you to adjust your contributions, so you can gradually increase the amount being invested each month. For instance, you could set a recurring increase of $10 or $20 every 6 months. Automation removes the need to make manual adjustments, ensuring that your commitment to scaling up remains consistent. Automated increases are particularly effective if you find it difficult to set aside additional funds manually. By automating, you can let the growth happen in the background while focusing on other financial goals. As you scale up, regularly evaluating the performance of your investments is essential. Tracking your portfolio's growth helps you see what's working and identify areas for improvement. Most investment platforms provide tools to view your returns over time, showing you whether your strategy aligns with your goals. Keep in mind that performance evaluation isn't about reacting to every fluctuation. Instead, look for trends over time and use these insights to make informed adjustments. For instance, if a particular investment consistently underperforms, consider reallocating that portion of your portfolio to something with better growth potential. Scaling up doesn't guarantee a smooth path. Sometimes, markets decline or certain investments don't perform as expected. These setbacks are a natural part of investing, and learning to handle them is crucial for long-term success. Instead of viewing setbacks as failures, see them as learning opportunities. For instance, if you experience a market downturn, take the time to review your strategy, assess your risk level, and consider how you might adjust for the future. This process builds resilience, helping you approach future growth with a more informed perspective. Scaling up your investments is a powerful way to bring your financial dreams closer. Picture yourself achieving the goals you've set, whether that's a secure retirement, a home, or a legacy for your family. Visualizing your progress helps you stay motivated and reminds you why you're making these gradual increases. Imagine the financial security that comes from knowing you've invested consistently, scaled responsibly, and managed risk effectively. This sense of security can serve as a strong motivator, keeping you focused as you continue to increase your contributions and build a brighter financial future. Chapter 8. Building Wealth Mindfully and Paying It Forward. You've learned how to start small, remain consistent, and gradually increase your contributions. Now, as your investments grow, it's time to think about how to build wealth mindfully and the impact that wealth can have on your life and the lives of others. Wealth can be a tool for freedom, security, and even a means of giving back to your community. This chapter explores how to enjoy the rewards of your investments responsibly and leave a positive legacy. Mindful wealth building means handling your finances with purpose and intention. Instead of viewing wealth as a destination, think of it as a tool to support your life's values and goals. With this approach, your financial choices are guided by what truly matters to you, rather than by external pressures or impulses. A mindful wealth mindset encourages you to be intentional about your spending, saving, and investing. When you understand what wealth represents in your life, be it security, freedom, or the ability to give, you make choices that are aligned with those values, leading to greater satisfaction and purpose. As your wealth grows, you'll reach a point where your investments provide a level of security and freedom. This freedom can enable you to pursue passions, spend more time with loved ones, or invest in personal growth. However, enjoying financial freedom responsibly is essential to ensure that your wealth continues to grow. Consider setting a budget that allows you to enjoy some of your wealth now, without compromising your long-term goals. For instance, you might allocate a small percentage of your investment returns each year for discretionary spending, while reinvesting the rest to continue building your future security. One of the most fulfilling ways to use wealth is by giving back. Whether through charitable donations, supporting family members, or contributing to causes you care about, generosity allows you to make a positive impact beyond your personal life. Generosity doesn't have to mean large donations. Small, consistent contributions can be impactful over time, just like your investments. Consider setting aside a portion of your returns for causes that align with your values. This approach not only benefits others but also adds a sense of purpose to your financial journey. If you're interested in giving on a larger scale, you might incorporate philanthropy into your financial plan. Many people find purpose in dedicating a portion of their wealth to community organizations, educational programs, or environmental initiatives. Some even create family foundations or donor-advised funds to manage their giving over time. You can start by setting specific giving goals, such as a percentage of your income or investment returns. This approach allows you to maintain a balance between building wealth and contributing to causes you believe in, ensuring that your philanthropy aligns with your overall financial strategy. As your wealth increases, it's common to feel tempted by lifestyle upgrades, bigger homes, luxury items, or extravagant experiences. While it's natural to want to enjoy the benefits of your hard work, be mindful of lifestyle inflation. Lifestyle inflation occurs when increased income or wealth leads to equally increased spending, which can erode financial progress. To counteract lifestyle inflation, focus on spending in ways that truly enhance your quality of life. This might mean investing in experiences that bring joy or personal growth, rather than material possessions. Mindful spending allows you to enjoy your wealth without sacrificing the long-term security you've worked hard to build. If you have children or younger family members, consider using your financial journey as a way to teach them valuable lessons about money. By sharing your experiences and the principles you've learned, you can help them develop healthy financial habits from a young age. You might start by introducing simple concepts, like saving and investing, and gradually teach them more about managing money. Setting up a small investment account for a child or helping them start a savings plan can also be a practical way to reinforce these lessons. Passing on financial wisdom creates a legacy that extends beyond money, empowering the next generation to build their own secure futures. Wealth isn't just about financial security, it's also about having the freedom to invest in your personal growth and well-being. Whether it's furthering your education, pursuing a passion, or enhancing your physical and mental health, using your resources to enrich your life is a meaningful way to enjoy the rewards of your investments. Consider allocating part of your budget for activities or learning opportunities that inspire you. When you prioritize personal growth, you're not only improving your own life but also gaining new skills, insights, and perspectives that can benefit those around you. As your investments increase, staying grounded can help you keep a healthy perspective on your wealth. Remember the principles that helped you start this journey: patience, consistency, and purpose. Maintaining these values as your financial situation improves will prevent wealth from becoming a source of stress or isolation. Stay connected to friends, family, and community, and focus on what truly brings you fulfillment. This grounded approach allows you to experience the benefits of wealth without losing sight of the things that matter most. Research shows that while wealth can contribute to happiness, it has its limits. Once basic needs are met, additional wealth tends to have a diminishing effect on overall satisfaction. This concept, known as the happiness plateau, suggests that money alone isn't enough for a fulfilling life. Instead of focusing solely on accumulating wealth, seek balance. Invest in relationships, experiences, and personal growth alongside your financial goals. This balanced approach will enable you to enjoy a rich and meaningful life, supported, but not defined, by your wealth. As you continue building wealth, remember that your legacy extends beyond money. It's about the values you live by, the relationships you nurture, and the impact you have on others. Whether it's inspiring your family, supporting a cause, or simply being a positive presence in your community, your legacy is the culmination of the choices you make each day. Reflect on what kind of legacy you want to leave behind. By investing in both financial growth and personal integrity, you create a legacy that resonates well beyond financial gains. Wealth is only one part of your story, the values and purpose behind it give it true meaning. Final words. As you reach the end of this journey, remember that wealth isn't built overnight, it's grown, nurtured, and carefully tended, one small step at a time. Every dollar, every choice, every mindful investment you make is a seed planted toward a future that's uniquely yours. This journey may have started with spare change, but it's led you towards something far more powerful: the knowledge that you hold the tools to create the life you envision. You now know that it doesn't take a fortune to begin, just a commitment to start small and stay steady. Let each choice you make from here forward remind you of the potential within you to turn even the smallest beginnings into something meaningful. Wealth isn't about where you started, it's about where you're headed. As you go forth, carry with you these words from philosopher Lao Tzu. Do the difficult things while they are easy, and do the great things while they are small. Today you've begun something small. Tomorrow, it will grow beyond what you once imagined. Thank you for embarking on this journey. Here's to your steady path forward and the wealth you're building, one step at a time. Take care and be well.